Well, good morning, everybody. Good. Is that a little too loud, or are we good with that? I don't know where Mike Brown is. He's my co-conspirator with these things, but I talked to him last night. He said he was going to be here, but he was up in the hospitality suite pretty late. So we'll see. He actually said that he doesn't have a PowerPoint per se for his part of the talk and things, and he said he figured people really wanted to hear what I had to say a lot more, so he was going to give me more time. And I said, people probably would be better advised to listen more to what you have to say than what I have to say. But it is an interesting time, so why don't we go ahead and get started. I am, as you all I hope know, Stan Longhofer. I'm the director of the Center for Real Estate at Wichita State University, and it is my great pleasure to be here today to talk about our just released Kansas Housing Markets Forecast series. That series wouldn't be possible if it weren't for the generous contributions of a number of companies. Lead sponsor, Security First Title, does great for us. They sponsor all of our housing forecasts. Ameritrust Credit Union sponsors several of the large publications across the state. CapFed sponsors Topeka. Fidelity Bank sponsors our Kansas City forecast. And then Credit Union of America has sponsored some of our smaller county outlooks this year. So we're very, very grateful for all of that support. It also wouldn't happen if it was not for the wonderful partnership that we have with the Kansas Association of Realtors and all of the local boards that all of you are a part of. Some of you may not know that we have had a contract, and the Kansas Association of Realtors helps cover the cost of preparing the monthly statistical reports that we send to each of your local boards. And that's covered through that contract that we have with the Kansas Association of Realtors. But because of that relationship, then we also have access to all of that data, which allows us to do the analysis for things like our forecast series. There are copies of these forecasts out in the foyer, and I encourage you to grab those. But more importantly, there are boxes and boxes of these forecasts that either are at or will soon be at your local realtor boards. And they would love it if you would come and say, I want to take 3 boxes back to my office. I'm serious. How many boxes does your office take? Do you know? 4 boxes. Agents use them in relocation packets. They use them in listing presentations, in other things. It's a useful way to have some outside perspective about what's going on in the market and where we've been. And so these have been amazing. These beautiful publications are available because of the generous sponsorships of Security First, Ameritrust, CapFed, and Fidelity. And so please take them, please use them, and I know the realtor boards would love for you to take them to your offices to free up some space of their limited storage. I would just say I'll make a special offer if there are any Kansas City brokers here that say, you know what, I'd love to have 2 or 3 boxes. I'm delivering all the Kansas City boxes over to KCRAR office after this meeting. Oh. And if you want me to drop some off at your office and it's not too far out of my way going back to Wichita, then I'd be happy to do that. Just let me know. So, the big question, and I'm going to spend a little more time on the economic environment today than I normally talk, is what's going on in the general economy, and are we in a recession? And any of you who took an undergraduate economics course, you might have been taught the definition of a recession is if we have 2 consecutive quarters of negative GDP growth. That is where the overall production of goods and services in the economy declines for 2 consecutive quarters. Technically speaking, we've met that criteria over the past 2 quarters, but they are very, very tiny real gross domestic product declines. And although that's sort of a working definition, a rule of thumb we often use, it is not the official definition of a recession. In fact, there is no official definition of a recession other than a group of private economists with the National Bureau of Economic Research. They're called the Recession Dating Committee. And they get together regularly throughout the year, and their only job on this committee is to define when a recession began and when the recession ended. And their goal with it is to be definitive, not to be quick. And so they will, if we are in a recession today, they probably won't tell us until sometime late next year when that recession started. That being said, by the way, anytime you see these shaded bars on any of the graphs that I have, those represent the official dates of recessions by the Recession Dating Committee. And one more thing. I saw Steve on his tablet here. If you want these PowerPoint slides that I have, they are posted on the Center for Real Estate website right now. You'll see latest presentation on the right-hand side. You simply go to wichita.edu/real estate, and that'll get you to the Center for Real Estate's homepage. So what I started to say is I'll be very surprised if the Recession Dating Committee says we're in a recession right now, given this 2 quarters of negative economic growth. And the reason is that economic output is only one thing they look at to decide, are we in a recession? They're probably more interested in what's happening with the job market situation. And job growth has actually been pretty strong nationwide. This chart's a little bit strange. It's total jobs reported by employers. And I normalized it to January of 2020 so we can kind of see where we were before the pandemic. And of course, you see the sharp declines. The US, we dropped about more than 14% total employment losses in the wake of the pandemic. Kansas, it was more like 11.5%, okay? But then notice that the United States as a whole has gotten to a place where total job gains, we now have more employment in the United States than we did prior to the onset of the pandemic. Of course, in Kansas, and this is true for every single one of our metropolitan areas in the state, we are still about 2.5% lower than we were prior to the onset of the pandemic. Okay, fewer jobs now than we had before. I think you may remember, I think Governor got a little bit of trouble for that because she was commenting on the recovery from the pandemic, and she was quoted national numbers, but the state numbers aren't quite there yet. And so you might say from a Kansas standpoint, maybe we've got some problems. But you couple this with our unemployment rates, which is measuring households, and our unemployment rates are at the lowest levels we've ever seen, okay? And it's hard to justify saying that we're in a recession when you have unemployment rates nationwide that are running at around, 4%? That's a very, very low unemployment rate. In Kansas, it's much lower. So how do we reconcile these two things? Well, I think there are at least two things that are going on. The unemployment rate looks at households. It looks at, calling up individuals and saying, do you have a job? Do you have a job? Do you have a job? And anybody who is either actively looking for work or has a job is in the labor force. And the unemployment rate is the percent of people in the labor force that don't currently have a job. But that's based on households. The employment numbers are based on businesses. How many people are working for you? How many people do you have on your payroll right now? And so 2 things I think may have happened here through the pandemic. Number one is I do think we had some accelerated retirements. People who were, the aging of the baby boomers, and they were saying, I'm gonna retire in 5 years or 4 years, and then the pandemic hit and they said, screw it, I'm done. And they went ahead and they retired early. So that accelerated people moving out of the labor force, okay? In addition, I think that prior to the pandemic, we did have a lot of situations. Remember the pressure to raise the minimum wage? You don't hear that anymore, right? Why? Because you go and you see Brahms is advertising for teenagers at $15, $16 an hour. It's wages at those lowest level, a lot of those service sector areas, those were jobs where people often would be working 2 jobs because they couldn't get enough hours to get full-time benefits, And so they needed to work 2 jobs to have enough income and also, to cover the fact that they weren't getting any benefits. With the labor market situation, wages have gone up for those jobs, and it's more likely somebody gets full-time work and gets benefits as a result. So somebody that might have been one person employed in the unemployment rate survey could have had 2 jobs in the establishment survey, the employment numbers. They now only have 1 job. They're still unemployed, but we are having that's part of why I think we see this shortage of workers that so many employers are facing. But again, these levels are going to make it hard for the federal recession dating committee to come back and say, we are in a recession right now. Now, that does not mean that we will not enter a recession. Matter of fact, I will give you one definitive prediction. The United States economy will go into a recession. Someday. The when is what really matters. And that's a really hard one to tell. Is it possible that the Fed will overshoot with the things they're doing and drive the economy into a recession? It's entirely possible. But we have not seen that yet. This is, all of you down in Wichita, as we speak, the Center for Economic Development and Business Research is doing their annual Economic Outlook Conference, and they are releasing, Jeremy gave me a heads up on his forecast numbers. Their forecast is that total employment in Kansas will be up 1.7% this year compared to last year, and that the total jobs numbers next year will continue to be up 0.7%. Now, the low forecast that he has, so this year, because of the uncertainty, he actually kind of has a high forecast, my best guess, and then a low forecast. And this is his best guess. His low forecast is essentially 0 employment growth. So he's, even in his kind of negative scenario, he's not forecasting significant job losses for the state of Kansas. And in fact, if you carry that forward to 2024, his forecast is if we end up in the low scenario, the growth will be stronger in 2024, kind of coming over all of that. And that's very much how I feel about the underlying labor market as well, is that could we see some bumps down the road? Yes, but I don't see a significant deep recession. But as soon as an economist says something with certainty, run and be scared, okay? We were put on this earth to make the weatherman look good. There's another measure that people look at for, are we in a recession? And economists will sometimes look at this thing called the yield curve. The yield curve is, what is the yield curve? So let me start with this orange line here on the bottom here. This is the 3-month Treasury security, and the orange line is 1 year ago. What interest rate did the federal government have to pay to borrow money for 3 months a year ago? It was basically 0. This is the yield on a 1-year Treasury security. And again, this was October 1st, 21, one year ago. And it was what? 6 basis points, something like that. A 5-year Treasury security, it was about 1%. A 10-year Treasury security was up here at about 1.5%. That's an upward sloping yield curve because it's saying that the longer the term, the longer you borrow for, the higher the interest rate. That's no different than the difference between a 30-year fixed rate mortgage and a 15-year fixed rate mortgage. You pay more to borrow for a longer term. The green line on here represents the yield curve 6 months ago, but at the top here you can see the most recent numbers that we have. September 30th was the latest date that we have, basically earlier this week. And there you can see that once you get to the 1 year, the 5-year Treasury security is just slightly below the 1-year yield, and the 10-year Treasury security is below that. Now this is not quite as downward sloping as it was a week ago, but it's still downward sloping. And many economists think a downward sloping yield curve is a predictor of a future recession. I tend to pull that back just a little bit. A downward sloping yield curve is an indication that markets believe short-term interest rates will decline in the future. Okay? Because I could get a 5-year yield by taking a 1-year Treasury security and then rolling it into another 1-year Treasury and another 1-year Treasury and doing that for 5 years. And in principle, the yield on those two options, getting a 5-year Treasury security or a sequence of 1-year Treasuries, the yield on those ought to be essentially the same. Okay? And so if I have a downward sloping yield curve, it means that investors must believe that the 1-year Treasury will be lower in the future. Okay? Now, one reason the Treasury security could be lower in the future is because we do in fact go into a recession and the Fed lowers interest rates. Okay? But it could also be that they think inflation will get under control. So there are different reasons. Now, I saw a hand here. Did you have a quick question? No? Okay. So, one of the things that I wanted to talk about today and give us all some longer-term perspective. All of you look like you're very young here in this room, and so you don't have any history. Yes, Steve, I'm including you too. Don't have any history about kind of where we've been. But this is consumer inflation. So inflation has been the big story that we've had this year. Jump up of inflation. And so I took it all the way back to 1960. The dark blue line is the inflation rate, the headline inflation number, and then the orange line on here is what we call core inflation. It's the consumer price index where we pull out volatile food prices and energy prices. And what I want you to notice here is that, we had these run-ups of inflation in the 1970, peaking up at just under 15% in 1980. And notice that core inflation tends to follow it. What that's telling us is that in those environments, food and energy prices tend to be very volatile. Okay? And in that earlier era, we were seeing that when we saw those increases in food and energy prices, it began to get embedded into the markets, and people were expecting inflation to get higher. And so the prices of all other goods and services were following up as well. Okay? So there's a close relationship here between changes in the headline inflation, and when that starts to go up, core inflation went up with it, followed it a little bit. But we got into the 2000s, and all of a sudden we started seeing core inflation really was just hovering around this 2 to 3% range, and headline inflation would bounce up and down, and there's the relationship between those two got much less tight. You see that? And I particularly want to point out this period in 2008 and 2009. You remember when we were all panicking, and that in 2008 when gas prices went up to $4 a gallon? All the rural areas were going to collapse because everybody was going to move out of the rural areas and move into the city. And within a year, gas prices dropped down below $2 a gallon. Well, all of that, we had this big spike in inflation. We were panicking. Inflation was above 5% that year. But then the following year, it was actually negative for the first time since the 1950s. Okay? Core inflation, other goods and services, really didn't move very much. And so that energy price spike was viewed as this change and I don't remember what all was going on in oil markets at the time, and then the shale oil boom and all those things. But it was viewed as not being core to the underlying economy. And so, we've had this bouncing around. Well, here we've seen more of a return to a historic, that core inflation has been going up. Now, the thing I want to say is that there are two things. I keep meaning to make a slide for this, and I'm sorry that I haven't. There are two ways, essentially, that inflation can be caused. One is what we've seen here, where we have a supply shock. So we had all of these supply chain limits, and we had things that constricted what we were able to do, and that caused the ability to produce goods and services to decline, which drove up prices, right? We've really seen that in the housing markets, right? In new home construction and so forth. That's a supply-induced inflationary pressure. And you remember a year ago when everyone was talking about inflation is transitory inflation? What they were really meaning is that this supply chain induced inflation is not going to become embedded into inflationary expectations. It will resolve itself. And in part, they were saying, quite frankly, there's nothing the Fed can do to fix that inflation anyway. Okay? The Fed cannot fix supply chain problems. Okay? Not capable. It's not a part of any of their tool sets that they have. But the other way that we can have inflation is demand driven. When you put a demand for goods and services that outpaces the supply of those goods and services. Well, over the past 2 years with the pandemic, we basically have seen both of those elements come into play. Supply constraints that have been pulling back the aggregate supply curve, driving up prices but reducing output, and simultaneously all the stimulus impact that the federal government has done has been juicing up demand, and that's why we've seen this really, really sharp spike. The Fed can do something about the demand side, raise interest rates, try and cool off demand, but they can't do anything about the supply side, okay? And so we need to keep all of that in mind with these things. So what matters for mortgage rates ultimately is expected inflation, not the current level inflation. But I thought it would be interesting just to look at where has the 30-year fixed mortgage rate been? I went all the way back to 1970, and then where was CPI inflation? And you can see that in the back 1970s, when we had CPI inflation kind of going up and doing its thing, mortgage rates sort of tracked their way up. This fact that mortgage rates really didn't decline here reflects that situation of markets beginning to embed expected inflation. We think inflation will continue, and as a lender, you need to make sure that you're going to get compensated for the fact that the dollars this borrower pays you back is going to buy a lot less stuff 5 years from now than it will today if we have good high inflation. As inflation got under control, it took a long time for mortgage rates to come back down and come much closer here so that the real mortgage rates were down. And you'll notice here, this is really the first time since back in the early 1970s, the actual headline inflation rate is substantially higher than the mortgage rate right now. Which means that investors who are holding these things right now, if the current inflation rate stays where it is for the next 30 years, they're losing money by lending you, and lending money to buy a house, okay? I don't think borrowers are that stupid, okay? Even when we've got this extraordinary, lenders are that stupid. Even when we've got all this extraordinary, unusual things with the Fed's asset purchases and so forth. And so I think where we are with mortgage rates is reflecting more of a sense that markets are going to return to a normal that we really haven't seen since prior to the financial crisis in 2008. Okay? And there's one reason that I also say that. So again, it's inflation expectations that get built into mortgage rates. And this is a slide that I showed you last year when we talked about this. Headline inflation, we're up above 8% here right now. But there's a survey by the University of Michigan where they call households and they ask, what do you think inflation will be over the coming year? Households' inflation expectations have gone up from about 2.5% since in the end of 2020 up to about 5% right now. That's their expectation for the coming year. But that's just somebody calling on a survey, right? You can say whatever you want. You may not have thought about it very deeply. The bottom line on here, the orange line, is something we call the 5-year break-even rate. And it's this clever device that back in the 1990s, the federal government began issuing what are called Treasury Inflation Indexed Securities, or Treasury Inflation Protected Securities, TIPS. And what happens is every single year, at the end of the year, they increase the balance outstanding on that security to account for actual inflation that occurred. So if you had a $1,000 par value bond, and inflation was just 8% last year, then at the end of the year, the amount that the federal government owes you jumps up from $1,000 to $1,080. And the interest that you get next year is going to be based on the $1,080 par value. Because investors are protected on the back end for actual inflation that occurs, they don't need to be protected for expected inflation on the front end. That's not true with traditional Treasury securities. And so traditional Treasury securities, the interest rates includes an inflation premium. The TIPS securities doesn't. The difference between those two rates is really a reflection of what the markets believe inflation will be, in this case, on average over the next 5 years. And you can see, despite this environment, the TIPS security, the 5-year break-even rate right now is about 2.75%. Okay? So that's above the Fed's inflation target, but markets are expecting that inflation must be coming down in the future. Okay? And I think that's part of what's driving where the mortgage rates are today. Okay? So, what is the Mortgage Bankers Association's forecast? By the way, as this morning, Freddie Mac reported their mortgage rates. They came down. They were 6% last week. 6.7% last week. They're 6.66% this week. So they came down. Better going down a little bit than keep going up. Mortgage Bankers Association's forecast is for mortgage rates to drop to 5%. That's lower than what's in that's a little higher than what's in the forecast booklets because we had to go to press and they've changed their forecast since. That's the danger of going to press. But again, I think they're also projecting that the Fed is going to navigate a softer landing with this. So how does that translate to housing markets? And I'm trying to make sure I'm giving Mike some time here before we go. So again, I tried to give some longer term perspective here. These are the actual home sales in all of the different MLS systems across the state. And then the blue line is the moving average, so we can see some underlying trends. Back in 2010, we were still coming out of the outcome of the financial crisis, and then we began this steady, long-term increase in home sales activity. And then we kind of plateaued back here in 2018 and 2019. Maybe some slight increases, but not much. And the reason was because, and we'll show this and talk about it, inventories had gotten so tight. It was just hard to find homes to sell. Well, then we hit 2020. We thought maybe they would decline slightly because of some tapering demand. The opposite happened. And here's my take on this. In the pandemic, the people who actually were able to pivot and work from home tended to be more knowledge workers, tended to be higher paid workers, tended to be people who were more likely to be homeowners. So the potential home buying population was less likely to lose their jobs during the pandemic, and ultimately feel pretty confident about their situation as labor markets tightened. Number two, they got all these stimulus checks. Even though they didn't lose their jobs, they got extra money. Number three, they couldn't spend any of that money because they couldn't go on vacation, they couldn't go out to dinner, do a lot of things they might ordinarily do. And so then number four, they were sitting around looking at their own four walls a lot more than they had been, thinking, I want something different, getting a little cabin fever. And number five, mortgage rates then dropped to the lowest level that they'd ever been. And I think there were a lot of people who said, we thought about maybe doing something different. We now have this cash, we can put a little more in. Never gonna see a better mortgage rate, let's do it. And so it really juiced up demand. And I think the thing that's really important is when we think about what happened with home prices over the past 2 years, it wasn't so much because of the juicing up of demand. What happened is that we had been laying kindling for about 10 years of this undergrowth in the forest that was building up and piling up the lack of inventory. And then we came through, and it's hard to know what you're doing with it, and we just hit all that undergrowth with a blowtorch. And that just caused this big bonfire in the housing markets. And so it's easy to say, oh, there was no bubble. That's my point. Because the fundamentals of lack of supply have been there for a long time and have been building for a long time. So one thing that people have talked about, I just wanted to briefly mention here is, housing affordability is at the lowest level that we've seen, in decades. So this is the National Association of Realtors Housing Affordability Index. What it measures is it says, what would it cost to buy the median priced home in terms of median prices, 20% down payment, current 30-year fixed mortgage rate. And then it looks at the median family income, and it asks, how much of the income needed to qualify for this mortgage does the median family have? And right now that number is 100. And what that means is the typical U.S. household has exactly enough income to meet the income traditional underwriting guidelines to afford the median priced U.S. home. Okay? In most of our markets in the U.S., in Kansas, that number is much higher, meaning that households have far more income that is needed to afford the median priced home. Where you'll see the news media talk about it is that since 2010, when mortgage rates really went down, affordability skyrocketed to levels that we had never seen before. Households had, at one point, twice as much income as was needed because the Fed was keeping interest rates artificially low and home prices were essentially flat for a number of years here or declining in some markets. And so affordability went way up. It was steadily coming back down, but 150 was still a good number. I've got 50% more income than I need to buy the typical house. It juiced up when mortgage rates dropped here back in the beginning of the pandemic, but then as people began to buy and then as mortgage rates began to go up, that has then collapsed. But again, keep it in perspective. I don't want to see housing affordability index go significantly below 100, but it has been there. You had it far below 100 back in the early 1980s. Okay, when mortgage rates were so high. I'd love it to be running, up closer to 150, but this is not the crisis that I think sometimes you're hearing people talk about in the national media. Okay? So, Kansas home sales forecast. Our forecast is for declining sales. I mean, you've seen it. There's just you all would have to do some amazing magician tricks to get to a place where we top last year's numbers by finishing this. Our forecast is down 6.9% for this year. I will say that we haven't tabulated all the numbers for last month yet, but I did see a preliminary thing from the Sedgwick County Appraiser's Office, and their September numbers were really down in terms of their deeds filed for housing transactions. So I'll be interested to see if September ends up being substantially lower. But our forecast for next year is a modest increase. Now, I think you should note there, 44,930 units. That's lower than we had in 2021, but it's a little higher than we had in 2020. Again, my longer-term forecast is that home sales activity will continue to not grow at a very fast pace until we resolve the underlying supply issues. But even with dropping of demand, actually dropping demand is probably a good thing for the market right now because there's more demand than we can effectively meet. And so I don't think that'll have a huge impact on sales going forward. So demand is certainly down right now, but the real problem is a lack of supply. Depending on what market you're in, compared to 2011, there are anywhere from half to 1/3 as many homes available for sale on the market right now. At the beginning of 2020, before the pandemic, half to 1/3 the number of homes that are available for sale back in 2011. Okay? Now, 2011, we were still recovering from the pandemic. But again, it's this perspective. This is a long-term issue of whittling down this available inventory. And so, even as demand softens, it will remain a seller's market. And you cannot see my little gray shading. You never know what will happen here. there is gray shading here between the 4 and 6 month supply mark here. And what we're saying here is typically we think of month supply of 4 to 6 months as balanced. We hadn't been in a balanced market in most of Kansas since 2015, okay? And prior to the onset of the pandemic, statewide we were sitting at about 2.25% month supply, and at the worst we got down to about half month supply. And so coming back up from that, again, is not necessarily a bad thing. I'm going to give you your 15 minutes there, Mike, so we'll make sure we get it there. A couple other things that I've heard in the national media that I just wanted to highlight and talk about, which is, I heard something from one of the national data providers talking about how the number of homes that were selling at a discount from the original asking price was beginning to go up, okay? Well, you can kind of see that. Yep, the number of homes, especially with the sold listings, you can kind of see that moving average trend is starting to curve up. But we go back to 2010 in the state of Kansas, it was about 80% of homes sold at a discount. Again, that was coming out of the pandemic, right? That we had a real buyer's market, people were negotiating down the sale prices. As we came to a more balanced market, that really leveled out to closer to about 65% of the homes that would sell for a final sale price below the original list price. You'll notice that when we hit the pandemic, that just cratered and dropped down to 40%. But we got a long way to go of those discount listings, and I think that's going to stop. I mean, I hear it from all of you. Those deep discounts. I'm sorry. Those bidding wars are cooling, but they're not disappearing. And so the extreme above asking price, we'll see more homes selling at a discount. But again, if we get back to 70%, that's just consistent with a balanced market. Okay? So that, again, it's this historical perspective that I want to really focus on here. Similarly with days on market here. Days on market back in 2011 jumped up to an average of, across the state of almost 75 days. And it steadily whittled its way down. And again, you can see the juicing of the pandemic. All of a sudden we went from where maybe we were kind of settling out at about 25, 30 days, and then it just cratered. And of course, in many markets, you were talking about days on market of 3 days, 4 days, 5 days. I mean, just really, really low. So is this going to come up? Absolutely, it's going to come up. But again, perspective of where we were, and even back in, say, 2015, 2016, with a more balanced market, we got a long way to go before we would say the housing market is crashing. Okay? So, home price appreciation. Again, I wanted to give a really long perspective on this for Kansas and the U.S. What we have seen is unprecedented. The home price appreciation that we've seen this year, U.S. average home prices increased about 12%, a little over 12%, in the peak of the boom prior to the financial crisis. Kansas, we never saw a spike back here in this bubble era. We didn't have bubbles in Kansas. Our home price appreciation was strong, but it never got outside the realm of what were for fundamentals. As a result, we didn't see a crash in home prices. We didn't see significant declines, minor declines, some, and a lot of just flatlining for several years. And then we finally got back to a pace where we had what I consider to be good, normal, healthy appreciation across most of the state. But that was getting harder and harder to satisfy, and then when we lit the match to the lack of supply during the pandemic, that's what's resulted in this. Across the state, on average, we had home price appreciation that was, what was the average last year? The last 12 months, through the second quarter of this year, it was like 17.5%. And who would have guessed that Topeka would have had the fastest appreciating home prices in the entire state? You had the most room to do it, so it's been the strongest. This can't continue. It will not continue, and we're already beginning to see the declines. So Again, we're up around 17% through the first half of this year. That's the latest numbers that we have. We're forecasting that home price appreciation is going to slow substantially, but with all the gains that we already had, we're still going to end the year up 12%. After last year, home prices increased 14.6%. These are big home price appreciation numbers here. Our forecast for 2023 is that appreciation rate is going to slow down. Again, this is not a cratering. 5.3% is really good, strong home price appreciation. Although if inflation doesn't get under control, that would be actually negative real growth in home prices. But 5.3%, if we get inflation back down, that's pretty consistent with what I would say is a really strong market with a lack of inventory. And so that's our forecast. So the last piece that we look at here, and I'm going to get you here, Mike. I'm going to give you 15 minutes, so we're going to be good here. The last piece that we have here is new home construction. And again, this is single-family residential building permits. I could throw in two-family permits as well, and it wouldn't really change this graph. I could add those together. Going back to the 1990, you can see that we were averaging, around 800 permits a month across Kansas through the late 90s, early 2000s. It bumped up a little bit during the housing boom, and then in the wake of the financial crisis, it just cratered. And so we've had a period here since at least 2008 where we have been building substantially fewer new homes than we have in the past and what we need for all of the general population growth. And one of the areas where we have seen a lot more construction, more consistent, has been in the apartment markets. Most of the state, we've seen a lot of apartments. And I've kept wondering in that world, are we going to overbuild? Actually, with apartment developers, it's never a question of are we going to overbuild? It's when will we overbuild? Because they always overshoot. Every apartment builder thinks that my 500-unit complex is going to be the best complex and everybody will want to rent there. And so when we've got demand for 2,000 new units and we have 6 of them build those 500-unit apartments, we end up with 3,000 new units when we only had demand for 2,000. That's actually pretty typical in the apartment market over long cycles. We just have not seen it. These new units that come out, they lease up, the rents are incredible, and it just keeps happening. And so I thought maybe Class B apartments are going to suffer. Everybody just wants to move up to the really fancy stuff. I talk to property managers, they say, no, we've got the best rent increases and lowest vacancy rates we've ever seen. I even go down to Class C, some of the crappy stuff. They say it's all pretty good. Where are all the people coming to want all of these housing units? It's not that people are moving from owner-occupied and wanting to go into renter-occupied. They can't find anything anywhere, which, by the way, the unavailability of rentals and the high rent increases is another reason why the fundamentals don't support a crash in the housing market. But I've been asking myself a question for a long time. What's been happening to average household size? A household is a group of people living together in a single housing unit. And by definition, the number of occupied housing units is equal to the number of households in the United States. Well, I could show you a really long perspective where this number's been declining for a long time, but I just took from 2000, where we had here the average people per household back in 2000. Let me look at this number and get exactly right. It was 2.62 people per household back in 2000. In 2021, the latest year that we have data available, it was 2.51, okay? Well, I took that number and just did a quick back of the envelope calculation. By the way, we did see a little blip here in 2020. People kind of moved back in with others. We saw a bigger blip in 2010 in the wake of the financial crisis, but the long-term trend has been down. If we had the same number of people per household in Kansas that we had back in 2000, that change has created a demand for an additional 49,000 housing units, just based on that change in household size. And so I think that's part of why we have seen this tremendous demand for housing and the supply issues, is that we haven't been building enough. And then in addition to the normal demand of population growth and replacing of old stock that needs to be replaced, we have shrinking household sizes that continue to put additional pressure on housing demand. Unfortunately, I'm not seeing a lot of increases in new home construction activity over the next year. Supply chain issues are there, mortgage rates going up are an issue, and labor market issues continue to be an issue. And so we need to continue to build new homes of all types, and we're doing it. We're doing more than we were a few years ago, but it's still not enough, and it's going to take us a long time to resolve all those issues. Well, I want to leave some time for Mike to talk about his things, and then after Mike's done, I'd be happy to answer some questions with mine as well. So all of that, please take copies of the forecast. Thank the sponsors for making that possible. And if you have questions or anything that we don't have time for today, then follow up with me afterwards. Email me or whatever. Yeah, Jamie.
I'm trying to think how to articulate this, and thinking forward for like the Panasonic plant that is supposed to be happening. How regionalized will that make inflation for the eastern half of the state for supplies for new construction? Because there's going to have to be an element of new construction to meet that demand.
Labor. So just a real quick thing about housing markets is that the markets for materials are national, even international in some cases. So that's going to be very, very little would be something that's a unique spike in Northeast Kansas. And labor markets, it turns out for a lot of construction workers, they're very mobile. When they've got jobs and they've got things, they'll look. I'd be more concerned about the hurricane.
Yeah.
The hurricane's going to be a bigger issue because my roofer that I use and I love, every hurricane he's heading down, he's doing all sorts of construction things with that. So, yeah, Mike, thank you. So, any questions? Yeah.
So beyond supply side issues, we've got a whole bunch of homeowners locked in at 3% interest rates, and now if they want to do a convenience move across town, they're going to have to borrow at 6.5% interest rates.
Mm-hmm.
What's that going to do to the? I know you said that the Fed can't fix the supply side. I think they can make it worse though. How do you see that affecting inventory in the future?
So, do we have a lock-in effect because we have all of these homeowners who have these fantastic interest rates that realistically will never come again, right? I mean, I think we have to expect that. Never say never, but never. The question that I go back to is those of you who may have talked to people who worked in the market back in the 1970s. Where you had homeowners who had mortgage rates that were around 6%, and then mortgage rates started going up in the 1970s. How much did that lock-in affect people there? I can't answer that. I'm not old enough to be able to answer that experientially. I'm not aware of any research that specifically looked at that and tried to quantify that. That might be an interesting research question to get at if you can get the data from that time period. But I think the real issue is that for the most part, people make housing moves first and foremost because of life stage situations. And so, yes, I've got this house, I have this great mortgage rate, but I get married, I have a divorce, I have more kids, the kids move out, we're ready to retire and downsize or whatever. Those life situations and those movements will continue to happen to people, and eventually that trade-off becomes such that, I don't care, I need this different house. And so where it might affect people is the bored buyers, right? I'm bored with my house, I just want something different. I know I shouldn't say that to all of you because you make a living off of board buyers, but that's a foolish reason to do a housing transaction in terms of your financial well-being over the long term. The transaction costs are just too high. And I don't mean they're too high in general, but it's high because there's a lot that's involved in doing a housing transaction. And so you should only make those moves when there's a compelling reason in your life situation to make those moves. You'll be better off financially in the long run. Yes?
Earlier this week, I heard an economist say that inflation or immigration was slower than it's been in years previous, and I was wondering how that affects inflation. Like, I'm sure it affects employment in some way.
I'm actually not familiar with what the immigration numbers have been, so I can't speak to that. So I'll take it at face value.
It was about 2% behind.
I'll take it at face value. Where that is going, the way that might impact inflation is ultimately through, I mean, if we did not have immigration in the United States, our labor market situation would have been in crisis mode years and years and years and years earlier. It's just absolutely essential for vast segments of our economy that we have in immigration. And that immigration is across all different sectors, right? It's you know, how many of you have doctors and specialists that come from outside the United States, right? I mean, it's not just construction workers or hotel cleaners, or, you know, sometimes we pigeonhole that immigration. It's every kind of job imaginable. And so, you know, in terms of dealing with our labor market shortages, that is a natural way to do it. And quite frankly, one of the reasons that we need that immigration is because all of us aren't having enough babies. And so, you know, we are barely at replacement rate with domestic population. And in Kansas, if it were not for immigration, we would be losing population. So, yes.
Why are all the foreign currencies falling so sharply against the dollar? And is that something the optimists are concerned about?
Why are all the foreign currencies falling against the dollar, and is that something that we should be optimistic about or pessimistic or concerned about? Well, I will give you a caveat. Foreign exchange things make my head spin, okay? Ultimately, it had to do, I think, with the Fed being so aggressive in pushing up interest rates compared to other markets, and so investors and so forth. But there are a lot of moving parts in what drives foreign currency and foreign exchange. Should we be worried about it? Financial contagion is a real thing, okay? And when you have that financial contagion, it can snowball into a lot of things. So I think it's worth keeping an eye on. But I mean, from a standpoint of me and my life, I can't do anything really about all of that. So I try and limit how much I worry about things about which I can't change, nor can I do anything in response to. Matter of fact, the only thing I'm thinking about doing something in response to is saying, wow, last time I went to London, the pound-dollar exchange rate was $1.65 per pound, and now it's almost even. So I'm thinking about traveling. Yeah.
Maybe one of the reasons is because we're the least dirty shirt in the laundry basket right now. It's a little bit better in the United States, a little more stable than it is in a lot of other places around here. So maybe that's why we're covered. That's my opinion. But my question is, you made this. My question is about the U6. The total employment continues to lag, and while unemployment is great, I'm concerned that we just don't have enough workers, and the prospects for having enough workers across the spectrum is not very good in the future, which I think will continue to keep wage inflation, make everything more expensive over time. What do you think?
Yeah, so he mentioned U6 inflation, and so the Bureau of Labor Statistics, I report the headline inflation number, and I'm trying to remember which one it is there. You know, they have U1, U2, U3, U4, U5, U6, and they progressively include more of, the headline inflation number is one where we basically just say, do you have a job or do you not have a job? But they also ask questions like, have you given up working? Have you given up looking? So discouraged workers. And they have an unemployment number that includes discouraged workers. Are you underemployed? Are you working at a lower level of skill or things than you want? Or you're working fewer hours than you want? They have several different nuanced measures of those. And they all sort of track the same general trends. So I still think the headline number. The question ultimately is, your question is about one of labor force. Okay, and do we have enough people entering the labor force? That's a shortage, and again, that's where the immigration numbers could help make a difference in that. Is bringing in people who are of prime working age and want to work. One of the things I remember for 20 years, I've been meeting with industry groups, and everybody comes to me and they'll say, we look at all the gray hair we have around here. We got people who are going to retire in the next 10, 15 years. We need to bring these young people in and get them into property management, get them into appraisal, get them into brokerage, get them into this, get them into that. And all of you have been aware this was happening and was going to happen. And again, I think the pandemic may have caused things to tip, kind of force a lot of people out more quickly than they were originally planning to. But we also know that the millennial generation is bigger than the baby boom generation, right? And so there's one other piece of it that I do think is relevant, which is that question of the choice that you make between dual income household versus single income household. And that has a big impact on that overall labor force and labor force participation rate. And I think it is a mistake that if somebody makes a household choice and they say, we'd like to have one of our spouses stay home, to say that that's a bad thing, right? It doesn't show up in general economic activity. But man, I can tell you, watching my mom and things she did, that's an enormous amount of economic value that she added by staying home. And it's not measured in the economy, and I think we need to value that and appreciate that people have the option to work at home, to do those things. Certainly, that work at home, so work from home move could make it feasible for some people who may say, no, I want to stay in the workforce, but I need to have some family responsibilities. Maybe it's aging parents that they need to be able to take care of. And there are a lot of places where this could happen. But it's ultimately we've got to bring immigration is the solution that we have for that, I think. Yes.
Stan, in your studies, are you watching where the needle moves or doesn't move between owner-occupied and tenant-occupied, that relationship? Because it feels like we're eroding a little bit out of owner-occupied and a little more into tenant-based.
Yeah, I don't have the slide with me here today, but yeah, I do track that movement of owner-occupied versus renter-occupied. I do think that one thing that happened in the wake of the financial crisis is that we had gotten, I personally think, a little bit overly distorted in the late 90s and early 2000s of everybody needs to own a home, okay? I don't think that's true any more than I think everybody ought to go to college, okay? We would love for everybody to be in a situation where they can be a homeowner if they choose and it's right for them in their personal situation. Same with college and that. But what I tell my students, what I tell people in the community is should you buy a home or not? Well, you need to be first and foremost vocationally stable. Are you going to be able to be in that home for 5-7 years in order to at least recoup all your transaction costs in that with normal appreciation that you have? And then you need to be financially stable. And I think one of the things that changed, and I really saw it here in Kansas City because we had at our roundtables frequently a relocation specialist who participated and talking about how relocation, corporations that were doing relocation work were really beginning to incent people into renting instead of buying when they knew that they were going to be moving corporate jobs every 2 years. And that actually makes a lot of sense. And that ultimately changed the segment of homes that were considered appropriate for rentals. We used to think of rentals as being sort of lower end homes mostly, and now we see rentals across all spectrum of that. And I don't think that's a bad thing. The question from a realtor standpoint is how often do investors buy or sell those transactions versus homeowners? And I suspect that investors probably tend to hold on average a little bit longer, which may reduce some transactions. But I don't think that it necessarily has to mean anything different for the industry. Does that make sense? Yeah, Steve.
What effect do you see of corporate investors in the single-family home market?
The impact of corporate investors in the single-family home market. I'm struggling a little bit to get my brain around this. My first thought with it all is that that was going to be something that was more in the new home construction, right? Investors really want to have, subdivision that they own, they control, and they do. And that's a big part of what we see it. It's been interesting to see the swath of saying we're going to buy the onesie twosies and put it into a portfolio and things. I'll tell you what I don't like is I believe very strongly in local. I actually got up on my soapbox with my students yesterday about local service providers, and talked about issues of using a local mortgage lender, because that local mortgage lender, if something goes wrong, there's somebody you can go talk to. And I've seen it in commercial side of things too, office buildings and other things where you have out of state owners, and maybe they use a local property manager, but the property manager's hands are tied behind their back because the owner they're not looking at the property every day. And so I do have some concerns about that, but I also think that that's something that tends to sweep. And so at some point, they're going to stop buying and they're going to start selling. And I doubt that they would do it in such a way where they don't. But you never know. How was that for a non-answer? Any other questions? I know we're out of time. Well, we're way over time. So some of you have places to go, people to see. So close deals, do things. If you have questions, please feel free to reach out to me. I appreciate it very much.